Sounds like the microphone's working. Test for the online. Can you guys hear me okay? Give a thumbs up in the chat or say yes. We got Faith over there monitoring the chat. Oh, I guess I need to. Oh, man. Slide advance. Yes. All right, good morning, everybody. Thank you for joining us. This is a test of our hybrid presentation systems. We got a good group here in person, and then we got a great group online as well. So we'll start off again. I'm Robert Theobald. I'm the Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority. And we're going to do a couple of housekeeping things. One, if you have questions, please put them in the Q&A for those online. Faith is with us. She'll be monitoring that so we can make sure your questions get asked. And then also for those that are in person, restrooms are down the hall. We also have microphones. They're muted right now, but if you hit the button, the green light will turn on, and then you'll be able to ask. And we ask if you ask questions that you do that so our online folks can hear and hear that question that was asked. So I didn't memorize the agenda, so I had to pull it up on the phone, but real quick, just want to start. I'm going to turn over to Ray Shea with the Phoenix Business Journal to say a few words, and then I'm going to jump into a little bit more. So Ray, all yours.
Thanks, Robert. Good morning, everybody. For those of you in person, great to see you, and those viewing online from home. And I'm sure the bathrooms are closer than they are to us here, but it's going to be a great morning. We're really pleased to have such a great participation here this morning. We have 4 outstanding presenters and companies that are part of this program too. This is the second in a series of 4 small business workshops where I know that there's going to be a lot of takeaways for a lot of people. And feel free to kind of come in and out. There's some of these presenters that might be of more interest to some than others, but bear with us, and I think you'll take something away from each of them too. So first, thanks to Wells Fargo for their participation here, and of course to REDW, to Gallagher Kennedy, and our new sponsor coming in today is Blue Cross and Blue Shield of Arizona. So thanks so much to our sponsors. We're really grateful to have you all here. And again, enjoy the program today. I know there's a lot to be learned. For those of you viewing on your home devices or at work, welcome. And we look forward to seeing you maybe in person next time for the next program too, which we'll start promoting that again shortly after this concludes in the next few weeks. Thank you all. Back to you, Robert.
All right. Thank you, Ray. Okay, so for those of most of you have joined because you've seen it either through the Business Journal, you may have been to our boot camps, and you're tired of hearing me do my spiel every Tuesday morning at 9 a.m. So we cut it down a little bit. Do want to go through a couple things real quick. One of the main purposes of this workshop is to be a companion to our small business boot camp, which is our Tuesday morning webinar that we do every week at 9 a.m. And we bring other presenters to share a tidbit about small business to help small business owners. We know the small business owners are experts at what they do, but not necessarily experts about every other part of their business that they have to do. And so our experts bring in contents, hacks, tips, tricks to help business owners do better, as it shows there on the screen, to help prepare, plan, and grow. With those webinars, we have a content library, and this is going to be recorded. And it will be part of that content library. You should be able to go in and, if you have to miss a session or a section of it for something, you can go in and watch that recording. And so it'll be part of the content library, which we talk about there. In this content library, we have over 200 recorded webinars and workshops. So it's a great resource that's available to anyone at no cost. So with that, we're going to look at some of our upcoming sessions. You can see we've got our today's workshops and then the next 3 small business boot camp sessions. So hopefully you can join us for one or all of those. You're welcome to. And again, we record them all. So if you can't make the 9 o'clock time, they are available on in the content library. So as we want to jump in, we got a full session today, so I want to minimize my speaking. So that's all my presentation. That's all you have to hear me talk today. We're going to let the rest of the experts here talk. So I'm going to go through real quick. I'll let each presenter do a quick introduction when they get up here, but I just want to go through the agenda real quick. First, we're going to hear from the accounting firm of REDW. They'll be followed up by Wells Fargo. And then after Wells Fargo, the law firm of Gallagher and Kennedy will go. Then we'll take a short break, about a 5-10 minute break, so we can get up and stretch. And then we will continue in with Blue Cross Blue Shield of Arizona. And then we will wrap it up with the small business development centers with the state offices here with us today. So we're excited about that. And then we'll have some Q&A at the end if there are any questions that may pertain to everyone or a certain part. Again, if you have questions, if you're in person, write them down. And if you're online, post them in the Q&A. At the bottom of your screen, you'll see the Q&A box. And so we can get those answered as well. But with that, we're going to go ahead and turn it over to our friends at REDW. I'm going to go get their presentation pulled up. And we do have the clicker up here for the presenters. Right side is forward. If you need to go back, it's the left side. And we are all good. So let me pull the slide deck.
Should I tell a joke? What do you think? Thanks, Mike. This is my right hand. Okay. Thank you, Robert. Good morning, everybody. This is the first time I've spoken in public in a while, so please bear with me. They keep me in the little cubicles most of the time. But thank you so much for coming today, and I appreciate your time. My name is Cheryl Fulkers. I'm a principal at REDW, a CPA and business advisory firm based in the Southwest. We offer a wide array of professional services. We do tax, audit, from compliance through consulting, as well as human resources consulting, wealth management, business software, forensic accounting, litigation services, valuation, of course, my specialty, client advisory and accounting services. I'm excited to share with you today. Bookkeeping is an essential function in your business for both legal and financial management purposes. We have assisted clients through most types of, financial reporting and investment transactions other than public. We don't do public. So today I'm going to share with you a CPA's perspective on the importance of bookkeeping for small business growth. So these are the topics I'm going to cover in general: the essentials, cash flow, tax preparation, business analysis, and then resources. So let's start with the essentials. So the essentials of bookkeeping are to record and report, and for budgeting. Bookkeeping is the act of recording and reporting on the results of your operations. It should provide you with detailed records of your assets, liabilities, equity, revenue, expenses, and cash flows. So this part is the really dry stuff, but we have to go through it. Just bear with me on that too. So the basic financial statements include a balance sheet, income statement, and cash flows. A balance sheet provides an overview of the company's assets, liabilities, and shareholder equity, showing how much money a company would lose or retain after selling all assets and paying off all debts. An income statement shows the amount of sales, expenses, and profit, hopefully, not losses, but sometimes that happens when you're a startup, flowing through a business over a period of time. Excuse me. This statement is sometimes called the profit and loss statement, or P&L for short. It culminates in the bottom line. Oh, I have some water, but thank you. It culminates in the bottom line, which shows a company's profitability or net income after all costs are accounted for. A cash flow statement is a detailed measurement of cash inflows and outflows to determine if a company is generating enough revenue to cover its debts, expenses, and investments. So it's essential that you have a system for recording those incomes and expenses. There's different ways of doing it. You can do it on a cash basis, which just means your income comes in, you record it, your expenses go out, you record those. If you're on an accrual basis, you're kind of forward looking. You're saying, I've billed this customer, but I haven't collected the cash yet, so that I've accrued the income. Or you have an expense, you've got a bill for it, but you haven't paid it yet, so you've accrued for it. In a nutshell, very basic. Anybody have questions about those basic items? Right. So cash flow is the #1 struggle that small business owners face on a day-to-day basis. Paying attention to the importance of bookkeeping can help you mitigate the challenge by keeping close track of the cash moving in and out of your business. There are many different models for managing cash flow. There's software that you can use. Most of the time, people just use an Excel spreadsheet that says, hey, I know I'm going to collect this much money. I know I have to spend this much money. And you can usually look at it like in a 13-week period, or you can go out as far as 6 months or further if you can get that sophisticated with your tracking. Accurate bookkeeping provides you with the information you need to plot when you need the cash, when you can expect to collect the cash, and when you need to be ready with outside sources. It's a thing that keeps most business owners up at night. So being able to rely on your accurate bookkeeping to help you make these cash flow projections is really important and helpful for the business owner. It keeps you with a clear picture of where you're at all times and what cash you're going to need going forward. I'm not sure where to point this thing. What about that? Okay, point it at Robert. So let's talk about tax preparation. Tax preparation includes many different kinds of tax. It could be income tax, sales and use tax. It could be compliance of any kind. For instance, we all went through the funding for the PPP loans. It required you to be able to pull information from like 14 different sources so that you could say, yes, I deserve this money. And then when you went to get forgiven, it's like, yes, I used the money exactly like I said I would. And if you hadn't had good, accurate bookkeeping, you wouldn't have been able to pull that information as readily. It would have taken a lot more work. Having complete and accurate bookkeeping smooths the process of preparing mandatory tax reporting. Now, that makes it sound like it's just easier for the tax preparer, but it really helps you, because if you can give a full set of books that are clean and done, all your expenses classified properly, your tax preparer is going to spend less time chasing. So where did you report this? And where's this? And why is this expense look like this? They can spend more time giving you tax planning advice, helping you position for like R&D credits and information like that if you are preparing those records properly. I think I'm talking really fast. Yeah. And if you are not organized in how you are collecting information from your customers, then, even during the simple process of reporting your sales tax every month becomes an overwhelming process. So having a method for organizing your data so that you can retrieve it and put it where it needs to go so you can meet your obligations. It's legally required that you file a tax return if you're in business. And legally required to file tax returns if you're in business. And there's other legal obligations you have. If you have outside investors, they require that you have accurate books and records so they can look and see how you're doing. They want you to be able to say, hey, I made a profit this month, and be able to support those numbers and show them where you came up with. And tax planning opportunities are easier to see if you're not chasing messy accounting. So, and that's a better use of your tax preparation dollars. If your books are done and they're clean, your tax preparer is not charging you to clean them up. So, that's a better use of your tax preparation dollars and for your planning. Okay. So the really fun part of having accurate books and records, gets really exciting, is business analysis. So when you're looking at your books and records, you said, okay, I made a profit with this customer, but not with that one. Why is that? So you're able to dig into those things and figure out, what did I do right with this one? What did I do wrong with this one? I'm thinking about expanding into another territory. So I look how I did in territory 1. What did I do right there? What kind of expenses can I expect to incur if I move into that new territory? And so that analysis helps you make those kinds of business decisions. In addition, this is where you're going to look at different kinds of ratios. Solvency ratios, like, is your accounts payable 3 times as large as your accounts receivable? Well, that's going to be a problem because you don't have enough cash to pay those bills. So you're looking for those metrics to see if you're in line with other business owners like you. That's one way that you're going to be judging yourself, is comparing yourself to other business owners or businesses that are like yours. And so, I just want to take a moment and slow down here and say, you shouldn't be spending a lot of time on your accounting. That's a job that you can easily outsource. Yes, I'm shamelessly saying that's what we do, but it doesn't have to be us. It's a job that, shouldn't be on your plate. Everyone thinks they can do it because they think it's easy, but it really isn't. It takes a lot of time to do that stuff accurately and know all the rules, and the rules are constantly changing. There's now rules about leases having to be capitalized. And unless you have your finger on the pulse of that, and Tony's really excited about that, then you may not have your book set up in a way that is going to be for the best use if you want to go to a lender to provide him or her with those financial statements so that you can get a loan. Or if you're looking at investors, they're going to look at your books and say, well, why don't you have your leases capitalized? Why aren't you up on the most current information? So I mentioned budgeting earlier. So, but part of the business or part of the decision-making process is also comparing what you expected to happen to the actual results and analyzing that. So that is the purpose of a budget. And I think it's really important for any business to have a budget and compare those things regularly so that you know, hey, I said I was going to hit sales of 20,000 with this customer, but I only hit 10, or I hit 40. What did I do right there to get twice what I was expecting? Or I expected my salaries to stay even, but they went up by 20%. Why did that happen? You're constantly looking at those comparisons and analyzing why those differences came into play. There are, I think I can move on to the next one now. So there are resources all over the place. You need advisors to help you with your accounting. And sometimes it's a CPA firm, sometimes it's not. There are different ways you could go for setting up your bookkeeping systems like Sage Intacct, QuickBooks Online, BotKeeper, Bill.com, Expensify, Fathom, Dext, Auto Review, IO. I just like software, can you tell? but we're always looking for ways to be more efficient, and we want to, and that's what you should want for yourself. You know, you don't want to be sitting there going type, manual entry. You want to look for ways to be as streamlined as you can. So you're going to look for partners that can help you put those software systems into place, assist you with making sure they're working the way that they should work, and using your staff. Say you have an internal bookkeeper. If you're having them type, that's still not the best use of their time. We all know the employment market is really difficult right now. You can't find staff. And so people are looking for all kinds of creative ways to overcome that. And one of those ways is making, excuse me, automated systems that will help you be more efficient. For instance, if you're using QuickBooks Online, are you downloading your bank transactions? Or are you typing them in? Are you downloading your credit card transactions? Or are you typing them in? You do, good for you, yay. So, and we use these systems on behalf of our clients and ourselves. And many of these systems are available with no long-term contracts, so that you can say, hey, I'm gonna try this thing, and if it doesn't work, you can, you know, perhaps move on to something else without being stuck in a contract for a long period of time. So, and I would also suggest you build yourself an advisory board. Now, of course, a good CPA or a good accountant is one of those things, but you know, you need a good insurance advisor, you need a good attorney to help you as situations come up that you haven't encountered before. Especially if you're new to business, you wouldn't know that if you don't file your corporation commission report, they're gonna delete you from the system, and then you don't have that corporate protection. And say you're incorporated as a C corporation or an S corporation or whatever. If you don't file on time, then they delete you from the system, and then you're exposed for anything that happens inside the company instead of having that legal shell around you. So, so all kinds of advice you can get that. So attorneys, CPAs, insurance people, copier people, you know, having someone you know that will help you with those kind of things is very important. And if you serve on a board, you know what that's like. You can help, you can understand that you're going to be giving advice to your, you know, you've given advice to the boards that you've served on, then you're looking for something similar for yourself. And another good source is there's retirees out there who like doing that kind of consulting. So look for somebody like that that would be willing to come in and help you. They've usually had 20 or 40 years more experience, and they're happy to provide those services. I know there's a couple organizations that do that specifically. And your board can be paid or unpaid. So there are So I'm down to the end here on my speaking part. So in closing, there are 5 items we recommend you do immediately. None of them are super technical, but do the essentials: record, report, and budget. Manage and plan for cash flow. Smooth the tax preparation, increase tax planning opportunities by providing those good records. Do your business analysis so you have good sources of information for making decisions and planning, and build a team. Your business will need accurate bookkeeping for growth and maintenance. Make sure you consider these points so you're ready before the day comes. That's all I have to say. Does anybody have any questions?
We have 2 questions from online.
Okay.
So the first one is good. I really like the questions from Elaine. It says, how many hours are too many hours for a business owner to be spending on their bookkeeping?
Well, I'm going to give the standard CPA response and say it depends. Because to a certain extent, you don't want to be doing the work. You want to be working on your business, not in your business. But you still have to pay attention to your books and records. So I would say at least 5 hours a week. If you have someone doing the accounting for you, then 5 hours a week is what you want to be. You need to be looking at reports, looking at receivables, collections, you know, where your cash flow is going to be. That is something you should be heavily involved in.
Okay. And the next question we have is from George, and it's a good follow-up to that first question. It says, besides QuickBooks, what other systems do you recommend to startup companies?
Well, there are a lot of them out there. QuickBooks Online is the one we use most frequently. Xero is very popular, especially internationally. We found that one to be really popular with other countries, but it has some really nice consolidation features. So that is one I would look at too. Xero. Xero, yes.
That's all the questions online. If for those in person that have a question, there's a microphone, press the button so the little light's green, and that way they'll be able to hear.
Okay.
I have a question. I'm my own business. And so in the behavioral health, I'm a therapist and I have my own company. So how would I go about finding out what is the market profit or losses based on being in the behavioral health and being independent?
Right, so you're gonna have to do some research. There should be information in periodicals that are about your business that says that gives you an indication of what profit and loss should look like. If you have a relationship with a bank, they should be able to help guide you with that. And of course, a CPA firm could help figure out what that should look like. Do you have friends that are in that business that you would feel comfortable asking?
I am contracted with the company.
Okay.
So I can ask her, but based on, she's an independent, but I'm contracting with her. So she got a lot of contractors up under her organization.
Right.
So I don't think that would mush, because she's so advanced than where I'm at.
Right. Well, I would say based on what you've told me, it doesn't sound like you have a lot of expenses. So I would expect your profit to be pretty high, 70%, 80%. But that is just surmising without having any details.
Okay, thank you.
You're welcome.
I'm going to say on that question too, when we get to Nancy with the SBDC, she'll be able to answer that question a little bit later on.
Okay.
To follow up on her question, you said she could check periodicals.
Mhm.
What is that?
Magazines or
Oh.
whatever behavioral health people look at to learn more about their profession. Usually they'll have a financial section in there. You're welcome.
I'm curious, really, the key point of time when you recommend a company to get CPA support. Is it a certain revenue point or certain threshold of employees? When is it really a key moment to get more help, especially for accounting?
Well, I think there's 2 answers to that question. My answer is at the very beginning. Why not get it set up properly? Because I've been doing this for decades, and I can tell you, I have seen some horrendous messes, and it's because the owner tried to do it themselves or have their spouse do it for them, or their sister-in-law or their uncle or whatever. I would say at the very beginning, you're much better off at least getting advice. What we do with a lot of clients, I have one that we set up. We did the chart of accounts for them. We went over what to goes where, and we met for half an hour for about 4 weeks. And that was perfect for them. So it doesn't have to be somebody that you're paying every month to do the account for you. If you want to do it yourself, there's different ways to model the relationship so that you get what you need and you're not ending up chasing mistakes down the road.
Cheryl, we're continuing with that.
Yes.
Could you explain how doing that at the beginning could answer that very first question we had about how much time a business should be spending on it?
Yes. Well, some people will insist upon doing it themselves, and I know that's the truth, but if we can help you streamline it, you're going to spend, like that business probably spends 2 hours a week. And he knows he's got accurate information because we've helped guide him to where he needs to go. So he's getting what he needs. Now, he doesn't need financial statements. He just needs tax preparation. So we were able to tailor the consulting so that he got what he needed. And any CPA would be able to do that for you. It's not just us. We're not that unique.
I have one more question. How important is point number 1 and point number 3? You can include point number 2 in there as well, but 1 and 3 for small businesses that might be looking to go get a loan?
1 and 3 are the biggest ones, both of them. You have to, in order to get to 3, you got to have 1. So I would say 1's the base. That's why I called it essential. It's the thing you have to do is get those records and reports accurate at the very beginning. And then everything else flows from that.
One last question. What are the top ratios that should be monitored? Like, for example, when you're talking about analysis, you said that there's key ratios that you need to be looking at in monitoring. What
Right.
would those be?
Well, I did mention one, current liabilities against current assets and current liabilities, specifically AR and AP, accounts receivable and accounts payable, sorry. Gross profit, net income. I mean, those are the real basic ones. And then it really depends on your business, like how much debt do you have? Excuse me, and then you're looking at how much you have to pay out, and do you have the cash flow for that? So they all circle around each other. And so every business, every kind of business has similar key performance indicators and specific ones for their industry. So it's important that you know what your industries are so that you can respond to those, make sure you're getting where you need to go.
I think that's all the questions we have. We don't have any
Very
more
good.
online. That's it. So we can go ahead and jump over to Wells Fargo.
Good morning. I feel like we could have left that last slide up too. I love the 5 examples there. I think we can use all of those when it comes to banking too. So Cheryl, I love you sharing that. Very cool. So good morning. My name's Tim Maxey. I'm a lead business growth strategy consultant with Wells Fargo. Little background about me. I've been doing this 17 years. Well, not this specific, but in banking 17 years. Throughout the country. Started in New Mexico, worked in North Carolina, here in Arizona, and in California as well, in Los Angeles. So my passion is working with small businesses, consulting, helping you all be successful in growing your business too. So my wife's a small business owner, my brother's a small business owner, just something that I absolutely love helping. So get the right clicker too, that'll probably help. All right, so what we'll cover today, we're going to look at managing credit, what lenders are looking for. That's why I love that, the slide of those 5 key areas. Our business credit life cycle. How do you want to look at credit and capital and financing during each cycle, stage of the cycle, making sense of different financing options, what's available to you, and then I'll share some educational resources for you. So we're going to start with financing opportunities. One key thing about credit is you don't want to be guessing where you're at. This should be a resource that you actively manage. So you want to make sure that you know where your credit's at for personal and for the business, and you understand how credit and additional capital could help grow your business. So how you can rely on it, credit can provide you with some working capital. There's so many different types of credit. We'll talk about it in a little bit. It will support business growth. So when you have some of those needs to where you could expand, or maybe you get a large contract and you need to go buy supplies, you don't always want to dip into your cash for that. So it's nice to have a line of credit or some additional funding set aside that can help with business growth. Take advantage of various opportunities that come up, and how your banker can be a resource. We've asked this before, and it's one of the key areas that not a lot of business owners do, is building a very solid relationship with your banker. Whatever bank that you're at, you should know your business banker. They should know all about your business. They should know what your goals are, what you're wanting to accomplish, and that's how we can more effectively help you out with those goals. So your banker can conduct a financial review your current situation, and discuss future business goals. So in taking control of your credit profile, again, I said this is a resource that you want to manage. So part of that is also reviewing your banking relationship. So looking at your checking, savings accounts, ensuring that that is separate. I would encourage you to not use your personal checking account or savings account for business purposes. And when we're looking at some of the cash flow projections, we're looking at finances, and we're trying to separate out on a personal statement what's for the business, what's not. That could be a nightmare. Cheryl, I can share with you an example that in my banking, we're looking at providing a loan for a business, and they brought in just a yellow sheet of paper ripped off of a pad that's like, yeah, here's some cash flow stuff. And I'm like, all right, let's try to figure this out together then. So being prepared, I love that again. Review your personal credit yearly. You do get free credit reports. I would encourage you to pull that up, know what's out there. If there's any problem areas, you can talk to your banker. They can talk to you about plans to help get things cleared up too. We're going to look at strong payment history. We're going to look at the relationship that you have with the bank too. What capital do you currently have with us? How do your accounts look? How's your relationship been? Banking strategically. If you spread your funds too thin across banks, that can be a struggle when we're trying to look at financials as well. We're trying to see where your money is. It also makes it overly complicated. When you're trying to go online at different banks and say, all right, this is my accounts receivable, and now I got payroll over here, but does it make sense? So I would say, look at that, consolidate where you can, and continue that banking relationship, and just demonstrate a consistent flow of funds. That's why it's good to have, consolidated accounts. We want to see where's the money coming from, where's the money going, how quickly is that cash flow happening. Visit your banker regularly, be clear about your situation and goals. And one thing I would really encourage here too is when you're meeting with your banker initially, discuss all those goals and what you're trying to accomplish, but look at credit right away. So if you're opening an account, it is so important, even if you just get a small credit card. You want to start building your business's credit right away. They'll typically always talk to you about a business credit card. They're going to talk to you about maybe a small line of credit, which both of those have their own needs or their own reasons to have. So a credit card you might use for your everyday purchases. you're buying gas, you're making small lunch purchases. You can build up rewards points on that. That can be additional small amounts of cash flow for you. Line of credit is some of those growth opportunities that you have sitting there, and an opportunity comes along, you need to dip into that without utilizing all your cash. So talk to your banker about that early. And if you haven't done it, I'm going to encourage you, wherever you bank at, go talk to your banker right away. Get to know your credit reporting. We're going to look at, when we're giving loans to a business, we're looking at business and personal credit. So like I said, get a copy of your credit report, know what's out there. What the bank is looking for, we're looking for your payment history. How long have you had credit? Are you making on-time payments? Are you paying things off quickly? What is your credit usage? Do you have maxed out credit cards? Or are you keeping your balance on your credit cards below half? I would definitely recommend that as low as possible. What is your debt load? How much do you have out there? Are you a little bit overextended, or do you not even have enough credit? So keep that in mind too. We want to know as much as possible about your credit. So when you know that, you can share that with the bank, and I'll get to that here in just a minute too. Credit scores, that's one part of your credit. So you could say I have a 710 or a 600 or 500. That's just one number. We want to know the story behind it too, and what led to that, how we can help you out. All right, 5 C's of credit. This is one of the things I teach to all the different branches of Wells Fargo that I support. And how do we utilize this information to help our business customers succeed financially? And this is something so important for you all to understand, is how do you continue to grow in these areas so you can be, I don't know the right word, very lendable with your business. So credit history, how you've handled past credit obligations. Again, you can look at your credit report. We're looking at this to uncover how you might handle the capital that we're giving you. Collateral, is there a large piece of equipment that you could be using? Is there a vehicle? Is there a building? We can typically give you a lot higher dollar amounts and better interest rates when there's collateral attached to the loan versus unsecured. Capital, we're talking about how capital can help grow your business. And this is one of those interesting ones that it's good to have money so that we can see, if something were to happen, would you be able to pay off the loan that we're giving you? So a common issue that we see with capital is that you had an equipment need and you went and used all the money in your business accounts to buy that equipment. And then another need comes along right away. And you're coming to us saying, hey, I need additional money, but we see now the accounts are at minimal balances. That could affect your chances of getting a loan with a bank. So really look at, how can I utilize credit and maybe hold on to some cash reserves. Conditions, this is a big one too. This is everything that affects your ability to repay the loan, including external factors. So we know we just went through COVID, and that caused changes in a number of different industries. There's a lot of regulatory issues with different industries. So make sure that you're aware of that. That's something that as a lender, we're going to be looking at to see how that impacts your business. And then capacity, how are your business generate enough cash to repay the loan? Again, we're going to look at cash flow projections. We're going to look at your financials to see, do you have the capacity to pay for this? All right, so what lenders are looking for, we're going to ask you a series of questions when you come into the bank too. We want to understand, what is your need? So explaining how you're going to use the money, and does the amount you're wanting make sense? So if you came to the bank and said, hey, I need $1 million. We're like, what do you need $1 million for? And you're like, I just need it, I'm going to grow my business. So we see that, but what specifically are you going to do to grow your business? Is that money going into equipment? Is that going to be for property? Is there a large contract that you have out there that you know that you could get if you had access to this fund? So we want to know the purpose, and does that $1 million make sense, or would it work with maybe a lesser amount as well? Your credit history, again, we're going to be looking at your credit for business and personal. The majority of business financing will require that there's a guarantor on that, which means we're going to look at your personal finances as well. So be prepared, not only with business finances, but with personal. And then application details. Ensure your sales and income numbers match what's on your recent return. Again, so important when you're looking at accounting, having the right documentation in place, knowing where you're at. And if you tell the banker that, hey, my revenue is $1 million a year, but on your tax returns, it shows a fraction of that, that could be an issue in getting you approved for the financing that you need. You want to look at, now that you have these reports, Cheryl showed, the importance of having that organized. And once you have that, you don't have to spend maybe as long in reviewing those things. But when you do, you want to look at, could you accelerate your inflows? Could you be processing invoices a little bit more quickly? Could you offer additional payment options? Could you be taking credit, debit cards, maybe in addition to just checks and cash? Could you be looking at Zelle or Venmo, depending on if that makes sense? Are you doing wire transfers? How is the money coming in, and is it quick enough? If you're sending out invoices and you're looking at 30 to 60 days before money's coming in, you might want to see, is there a way I could speed that up to have money coming in quicker? Monitor your costs, track bills and inventory, know payroll obligation, know what's going out. You'll see point number 5, I'll just skip up there, challenge everything. If you're looking at, man, this bill is killing me every month, challenge that. Is there somewhere you could go that's a better deal, that's a little bit better for your business? Watch your outflows, manage cash flow with credit, take advantage of trade discounts. That's a big one. If you can pay the majority off in 10 days and maybe get a 2-5% trade discount, use your line of credit to pay that and then pay it off quickly so you don't have to worry about the interest. So again, pretty important how a line of credit could help you with some trade discounts. And then cover your taxes, have money set aside. You don't want that tax bill to come up and now you're just like scrambling. How do I pay this tax bill? I got to put that on credit. It's better if you can just put some money aside, knowing that you're going to have taxes every year. You got to pay them. So put money aside for that and be prepared so that doesn't become detrimental to your business. The credit life cycle, we'll go through this fairly quickly. It's important to know where you're at and how can, what financing opportunities do you have during? So first one is seed or startup. During startup, a lot of times we see that people are using personal finances. We've seen home equity loans, credit cards, all kinds of stuff used to get your business started. And I get it. You have this great idea and you want to be able to get it off the ground and start making money. And that's sometimes what you got to do if you don't have that investor lined up. But knowing that, you might want to get that refinanced and taken care of quickly. You don't want your personal finances tied up too long in the business. Again, talk to your banker, let them know what your goals are early on. When you have that idea, go to the bank and say, hey, I'm just working through this. I want to talk to you. What funding opportunities do I have? Banks will lend to businesses with line of credits, credit cards, potentially even up to $100,000 for a startup. We also work with SBA and we can do loans that way as well, or lines of credit. So talk early on with your bank. We'll also give you resources, and I guess I can go back on that too. I have micro lenders on there. We'll give you resources. If for some reason we couldn't get something done, we do work with a bunch of micro lenders that we can get you.
Hey, Tim, we had a couple of questions that tie in right here really well.
Oh yeah.
And it was, where can they go to get their free credit score check?
You can go to any of the major credit reporting companies, Experian, TransUnion, Equifax, and I think they're mostly just like Experian.com. And when you go on there, they might try to sell you on something when you sign up. So you don't have to pay anything. You can request your free credit report. Yeah.
So I have 2 questions. The startup, I did attempt to get a loan for my company, but because it was a nonprofit, they said that they cannot provide a loan. So I'm looking into changing that. And the next thing I wanted to know, because you spoke of having credit in your business. So I use my vehicle to travel and it's in my personal. So would it be a good idea to refinance it up under the business and that'll show that it's a loan up under the business?
Potentially, yes. If you're using that car exclusively for business, that could work. And again, I would recommend talk with a tax advisor on where you should go with that. But it is a possibility that a bank could help with, depending if it's the right thing too. Yeah, and the nonprofit, that can get a little tricky too. But again, talk to your banker, because we do have resources as well. And after the presentation, I'd be happy to share some resources with you as well. Yeah.
Thank you for all the great information. This is, there's so much on here. You talked about, and really appreciate this, separating your personal from your business things. And oftentimes the small businesses that we represent get asked to provide a personal guarantee. What is your counsel and advice for a small business? Is that something they should agree to do, should stay away from? And how does that play into that keeping things separate? Thank you.
Yeah, we're always going to look at, we're looking at business and personal credit. We're going to ask, at least from Wells Fargo, a guarantor on every business loan that we do. So we are going to have that. You do want to have it still separate, because we want to look at business finances. We want to see that very clear. What does your cash flow look like? Are you profitable? But we also need to see on the personal side, how are you managing your personal credit as well? We'll ask for a personal financial statement. We'll see what you have out there. And unfortunately, we've seen in cases where you might have a profitable business, but one of the business owners wasn't managing things on the personal side. I had one not too long ago, a couple of years back, that one of the business owners went bankrupt, and it would have been a great deal, but there's that bankruptcy there that pretty big impact that ultimately, when that comes out in the process, that creates some issues with the business owners as well. But it is that important that you want to keep it separate, but manage both in the interest that it can impact the business as well. So hopefully that answered the.
Well, I think most small business owners, I guess what I'd say, should expect that they're going to be asked to provide a personal guarantee, even though the loans are for business.
Absolutely. Yeah. Every time we're going to look at that. Yeah. Right. On the growth phase, you'll look at some different opportunities. You could be getting a business line of credit. There's SBA 7A 504 loans. You may want to start looking at refinancing, purchasing commercial real estate. This could be the point where your business has gotten to that. Looking at real estate equity. Have you started to build some equity in your real estate? We also offer a lot of healthcare financing too. A lot of banks will do that. During the maturity phase, you want to keep your edge in business. And one of the ways to do this is start looking at, could I save money? Could I pay down some debt? Could I refinance my equity? Could I refinance my property? Do I need to open a line of credit with some of the equity that I've built up in my property? I would encourage you, if you do have property, start looking at this. We are in a rising rate environment, so it's important to start looking at these now. During the expansion phase, you're starting to mature. You may look at additional areas that you want to do business. You might want additional properties. So we're looking at real estate financing, SBA 7A 504 loans, and healthcare opportunities. And then you eventually get to the transition phase where you might look at, do I want to sell the business? Am I going to close down? What am I doing as I start to retire, and think about that? So you want to pay down debt, refinance any loans that you have out there, put your business in a place that if you are going to sell it, it's very marketable too. So be thinking about that. And then I'll go through this just quickly, knowing some of your options for financing. There's secured and unsecured. Secured is when you have collateral. Unsecured is when you don't. So that's the most basic definition there. Multiple options for securing financing for your business. You got credit cards. That's your everyday expenses. You don't want to be financing larger things on a credit card, because if you max out a card, that could start to hurt your credit a little bit there. Line of credit, this is your revolving source of funds. This is your capital that you just have setting aside for those opportunities to grow your business. These are typically unsecured. We do offer secured lines of credit, but the smaller lines typically unsecured. Commercial real estate financing, so purchasing property, freeing up cash. You may want to borrow against the equity that you have. Most banks will work with the SBA to provide loans and lines of credit. And then at Wells Fargo, we offer separate healthcare financing as well. You may need to think creatively to get additional funding as well. So here's just some ideas of other sources of capital. There's seller financing, factoring, which is also called accounts receivable financing, peer-to-peer lending, mission-based lenders, and community development grants. Again, I would recommend that you talk to your banker about these if you're having struggles getting access to capital through lending. And I'll wrap up with just some educational resources. I'm with Wells Fargo, so I'm going to encourage you to go to wellsfargo.com, click on small business. There is a ton of stuff on there. You can look at insights, credit and financing. There's information on cash flow, financial management, planning. We have some, there's a competitive intelligence tool that will help you if you're starting to look at, in my industry, what are other businesses doing? I would encourage you to look at those resources out there. If you have questions, let me know. I'll be sticking around, and look me up on LinkedIn as well. We can connect on there. If you had any questions, just look up Tim Maxey. I'll be the guy at Wells Fargo. Looks like this. All right, so that's it. Any additional questions?
Yeah, we have some questions from online. The first one says, how do I build a relationship with the bank when the staff at the bank are not knowledgeable about products and services? And then it says, I have been a customer of Wells Fargo for years. When I go inside the bank, I am told to access the online services.
Yeah, that's a tough one too. Whoever had that question, I would encourage you, look me up. And I'll just give you my email too. It's tim.maxey@wellsfargo.com. I'd encourage you, email me. I'd be happy to connect you with somebody that is knowledgeable. And for your business, work with a business banker too. You might go into a branch wherever you bank at. The tellers may not have that kind of knowledge. A personal banker may not have that knowledge. You want to go to a business decked banker. So wherever you bank, look for a small business banker. They have been uniquely trained to help your business with this. But whoever had that question, send me an email. I'll be happy to connect you.
And then we have a couple more questions online. Another one was, where can a brand new business get enough money to meet the down payment required for a large SBA loan?
Yeah, you may want to look at investors for that. There's plenty of opportunities, and I don't know if we have anybody speaking on that today, but that would be probably a big area. Look for investor, look for maybe family that might want to help out. It could be tough. I get it when you're looking for lending, you can't really get a loan to pay a down payment for a loan. So that's where you have to get a little bit more creative about where do you uncover.
And I would say on that, some of those community focused mission-based lenders, they're usually CDFIs, community development finance institutions. They can sometimes work with you to start with a micro loan, then a larger micro loan, and build up to where your down payment on the, your portion of the 7A might be smaller, and or you may not need it at that point. You may have enough revenue coming in and built up enough cash in your bank account. But
and we do have a list. If you go out to wellsfargo.com on the business site, we have a list of CDFIs that you can look at too. I'm sure a lot of others have that as well.
Yeah, the SBA also has a listing for Arizona that lists all the lenders, including the CDFIs and the non-traditional lenders. It's a great resource on the SBA's Arizona district office page. And then we have, says we have a $600,000 line of credit that is not currently being used. Our bonding agent suggested we increase a line of credit to 1 million. What are the pros and cons of doing that?
It depends on the need. If you're being recommended to do it, I would assume that there's probably a need that you might have for that dollar amount. So again, if you're looking at the growth stage, if you're looking at maturity and you need to have, X amount of capital available at any time, I mean, I'm always for additional financing out there too. So cons could be if it becomes a little bit too much for your business. And if you're thinking that, all right, my next step is I also want to go get some property, that's going to be something we're looking at though. So now I went from 600 to $1 million. Is that going to impact future lending opportunities? So again, we're going to be deep diving your finances. We're going to look at cash flow. We're going to look at your capacity to be able to handle that. So talk to your banker. And if we feel like, man, you can definitely handle that, $1 million, we'll make it available for you, then absolutely, I see that as a great thing. Any other questions?
So you mentioned in your presentation that you're seeing companies use Zelle or Venmo as a way to collect their revenue. Do you see larger companies offering that service?
Not really. No, larger companies, that could be kind of tough to collect that way. I see that with smaller sole props. My wife uses those a lot. She has a notary business that she's all around. She wants to accept as many payment methods as possible. So somebody can't say, oh, I don't have a credit card, I don't have cash, I don't have a check. She's like, all right, I got Venmo, I got Zelle, I got whatever you want to pay me with, I'm going to take your money. So yeah, it's, bigger businesses typically aren't going to use that unless they have like a one-off small thing to do. Yeah.
No, thanks again. I mean, you talked about, just so many different types of credit, all the different kind of lending there is. Can you just quickly speak, are there better types of lending for better types of transactions? Like if I want to get a piece of equipment, should I look to this kind of, if I'm having a hard time collecting my receivables and I need cash flow, or if I want to buy real, what's the right kind of debt for them, or doesn't it matter?
It definitely matters. And talk to your banker. I feel like I'm a robot saying that, but it's so important to tell your banker if that's a struggle or you're wanting to accomplish something, let them know what you're going through. But yeah, secured loans for equipment. If you're looking at a larger piece of equipment for your business, try to secure that. We're going to get you a better rate. We could get you the funding that you need. One example is like a restaurant that we've helped in the past that their walk-in freezer broke. So we had to get them quickly set up with another walk-in freezer. We secured the loan with that freezer. So a lot of businesses might just come to the bank and say, hey, I need money right now. I need a line of credit. And that could help you pay for the freezer, but is that the most appropriate loan for that? So again, if you share with your banker, this is what we're going through, we're gonna look at that for you and see, could we secure the loan? If not, for just cash flow, you might want to just have that line of credit sitting aside too. So if you're having issues with receivables coming in, that's where a line of credit can really help you out, manage your cash flow.
This might be a tricky one, but for a tech company that doesn't have a lot of physical assets, such as like a commercial space or a lot of equipment, but it's tech services, what could be some key collateral to try to build business credit?
Ooh. Yeah, that is a tough one. It kind of depends on what you have. There is, they can get creative with certain types of financing too on what you have going on in the business. But I would say email me and I could probably get you in contact with the right banker that specializes there. I don't want to guess and tell you that.
Yeah, I totally understand. I knew it would be.
There is options to help.
Yeah. I mean, at that point, would you say it's mostly going to lean on personal credit drastically then?
Not necessarily. It depends on where you're at in the business too. How long you've been in business. Have you built up credit for the business? If it's brand new, then yeah, we might lean a little bit more on the personal side.
Okay, thanks.
We had another good question come in. It says, what is the debt coverage ratio that Wells Fargo usually uses for smaller companies?
That's a tricky one because it's going to go depending on what you're going for. There's so much that goes into that. I would look to be under 40% for most things. The lower, the better.
Regarding the line of credit, so with my personal, I have a line of credit. And sometimes I need to use that line of credit, all of it, like to pay off something. And then like 2 weeks later, I pay it off. Is that a negative?
No, actually, I love that because you can get reward points on that too. A lot of line of credits have rewards based on it. So if you're paying everything on your line, you pay it off right away, you're not accruing interest and you can build up rewards. That could be a huge source of cash flow for you. The one thing to keep in mind though, is when it comes to us pulling your credit, your credit report may show that you're overextended on that card. So you want to be prepared with statements that show you pay it off every month to overcome that type of objection. So the bank may come back and say, yeah, I'm sorry, you're maxed out on your card, but you're like, I paid that off. So just show the statements and you can overcome that pretty quickly. But yeah, great way to utilize your line. Mhm. All right.
So we had a question come through and I'll answer real quick. It was on non-traditional sources of funding. We've actually done some boot camps on that, and we can, if you email myself, Robert, or Faith, contact us, we can guide you to those boot camp webinars that we've done that on, because that could be a whole nother hour or two just talking about non-traditional lending. But we do have some resources that you can watch and review on that. Any other questions for Tim? Awesome, thank you. All right, we're going to switch over to Gallagher and Kennedy, and I really want to just a quick mention of the flow of this. We started with accountings because that's a basic part of your business that you got to do as you're preparing for debt lending. But if you're a company that where equity financing may roll in, then you're also going to have the same stuff prepared along with a little bit more legal counsel. So I'm going to pull up their stuff as they get ready to go.
After this presentation, everyone here, we do have a brief break. We do have a check-in sign-in sheet that will be available at this front table. So during that break, if you would go ahead and complete that, that would be great before you grab your coffee.
All right, well, good morning, everyone. My name is Dominic Sangelo. I'm with the law firm at Gallagher and Kennedy. I'm here to talk about raising capital through equity offerings, things to consider, ways to prepare. Going to be very similar in a lot of ways to Tim's presentation in terms of thinking about capital needs and how to achieve them. So a little bit about me. I'm an attorney, like I said, Gallagher and Kennedy. I practice in corporate mergers and acquisitions, securities, and kind of general business law. I represent companies at all stages. So some are clients that come to us and say, we have an idea for a company. We haven't even formed it yet. How can we get started with forming our company? All the way through representing public companies that are traded on national exchanges. So our practice really runs the gamut of size. Not mentioned on here that I thought I might include. I also moonlight as an adjunct professor at Grand Canyon University as a business law professor. So hopefully this will be, sort of similar to my class where we try to cover something that's an entire semester worth of law school in about 25 minutes. So this is obviously a presentation about how do you get money for your business. So, we're going to cover some high level capital raising considerations, some different steps you can prepare to get the best outcome from an investment round. If we have time, I'll share some warnings, some pitfalls, some war stories about things that our clients have done, good and bad. And hopefully we'll have the right amount of memes. What's also in store is perhaps death by PowerPoint. If you're feeling this way, I suggest break you a little more coffee. I've had 2, so we'll see if I make it through without having to go to the bathroom. But the first question I ask clients when they say we have capital raising needs is, well, why are you raising capital? What are your business goals? What are you trying to do? If you sell shirts and hats, you're obviously going to have a little bit different business model, different considerations for what kind of equity you want to raise, what kind of investors you want to get, versus if you're a technology company or you're a pharmaceutical development company where you might not have any cash flow for years down the road versus somebody that might be cash flow positive in year one. The main thing to be thinking is, how is this capital going to help you actually achieve those goals? Is it to scale? Is it to be able to increase your sales team? Is it for research and development? Is it to launch a new brand? All these different things you should have in mind before you decide to approach investors and say, well, I need money for something. And do you have a concrete plan on how you're going to use the funds? Often I talk to early stage companies and startups say, well, we need cash to get started. It's like, okay, well, what are you going to use the money for? Do you have a plan? If an investor says, how much of this investment is going to go towards salaries for the founders and the executive team versus research and development? Those things matter a lot. So having a use of proceeds kind of thought through on the front end will help you articulate your pitch to investors much more cogently. But before you even reach out to investors or think about doing an equity offering, I encourage people to think, is equity financing the right way to proceed right now? So it might be, well, I know that startups go to venture capital and they talk to VC firms and that's just what you do. But it might not be. There might be other sources of finance that are more appropriate for you. So the most obvious way to fund your business is capital from within, putting your own personal funds into the business. Obviously, the good news about using your own personal funds is you don't dilute yourself. If you're the only owner of your company and you add personal funds to your business banking account, as Tim mentioned, that also a good idea for corporate shield protection. You want to move those funds into the business, but that would be really good from a dilution standpoint. If you're the only owner, you put more of your own money into the business, congratulations, you're still the only owner. There's no loss of control. So when we think about owning your business, you're really kind of owning two separate rights. You're owning a right to the profits and losses of that business. You're also owning the rights to operate and control that business. So your voting rights, how much management control you have. If you don't take in an outside investor, then you still control everything. There's no payback schedule other than your own personal needs, which is great. So unlike bank financing, you don't have a monthly payment coming due or a balloon payment at the end of a term loan. One of the other things you can do is sometimes you can ask your employees to work for cheaper or for free by taking equity in the business. It's a really common thing a lot of startups do to attract talent that otherwise would demand a higher salary. You might offer to some of your employees, well, how about we offer you stock options or equity incentives or profit units or some type of equity security so that your employee has an incentive to stick around, participate in the upside of the business, and maybe you don't have to pay them as much in cash. Obviously, there are cons to this as well. There's more limited amount of capital. You only have so much money in your personal bank account unless you're Elon Musk. Even if you are Elon Musk, you're going to be less diversified in terms of what your own personal assets are. If your small business ends up taking up a huge chunk of your own personal net worth, that's not good from a financial perspective for you. And raising from within, if you do have other owners or other investors, they might be tapped out and say, look, this is money I gave you, that's all I want to invest. Capital calls are not always well received. If you go to your current investors and say, hey guys, we need more money, so it's time for you to pony up. Obviously, there's the bootstrapping option, which is the most traditional way of growing your business with funds. It's using cash flow that the business generates and reinvesting it. The pro is similar to funding it with more of your own personal money. You don't get diluted. You don't lose any control when you do it that way. You can kind of manage your growth and be methodical. And also it kind of proves the business model. If you're reinvesting cash and growing, investors like to see that. The con is that only works if you have sufficient cash flow. So if you're a company working on software or technology that is in the pre-revenue stage, or maybe you're a drug development company that's doing R&D, and maybe 10 years from now, you'll make a boatload of money, but until then, you're just going to burn a lot of money. Bootstrapping is not really going to work. The other thing to think about is it's much slower. So if you're trying to scale quickly, you're trying to build your business fast and grow and get ahead of the competition. If you're just reinvesting your profits, you might not get there very fast. Your competitors might get there quicker than you can. So obviously the next choice would be, well, maybe we can borrow money. And Tim did a nice job talking about that option. Borrowing money has some real pros. Again, no dilution. The bank is, as much as people like to say, well, I partner with Wells Fargo Bank, or Wells Fargo is a great partner of ours, or whatever. In a legal sense, they're not. They're just a source of capital. They don't make more money off of you if your business grows 10x. They're pretty much stuck with whatever interest rate they decide to charge you for that loan. So the good news is, if your business takes off and you do really well, the bank is only going to get a fixed amount of interest, and you're going to get all the upside. There's no loss of voting control either. The bank or whatever lender you have is typically not going to have a board seat. They're not going to have a voice in management decisions. Other than if you read the fine print of your loan agreement, there's probably a bunch of covenants that say things you can and can't do. And so the bank is not often going to participate in in management strategy decisions, but they might say things like, you're not going to pay yourself any distributions until our loan's paid back, or you're not going to take on certain types of debt. There's going to be all kinds of restrictions that they might put on you. But for the most part, they're not going to have a vote. Some of the cons, obviously, is that you have to pay the loan back. So you're going to have to pay that back typically with some rate of interest. And they're going to want that kind of regardless of how well your business does. If you say, well, cash flow is a little bit tight right now, they're going to say, well, we have some refinancing options, but they're not going to just wait to get paid necessarily. Another con is obviously the priority of the capital return. If you liquidate the business or there's some kind of exit event, they get paid first. So your debt holders are going to they're going to be first in line to get paid whenever you have some kind of exit, whether it's a good exit or a bad exit. Typically, they are first in line. So there's less risk to the bank if your business fails and you go into bankruptcy. You can liquidate the assets. The bank can get paid back on some of those, and the equity holders are going to be left holding the bag. The other con is it might make raising further capital harder. So if an investor sees that you have a ton of debt, they might not be as interested in investing in your company, knowing that they're going to be second in line to those creditors. So the moral of the story is that if you borrow money, you're going to have some money to be able to pay them back. The good news is that with equity investors, not necessarily. You can offer them a piece of your company, and if it's worth $0, giving them 30% is not necessarily a bad trade for you. So if we're talking about raising capital, and if your own personal funds are tapped out, if bootstrapping is not going to work, it's too slow, or you don't have any cash flow, debt doesn't make sense because you're not going to be able to pay it back, or you've already kind of maxed out how much debt you can take on, or if you're a tech company with not very many assets, maybe you don't have good collateral to offer. Although I will suggest to you that sometimes you can offer your intellectual property as a software company as collateral. Some lenders are excited about that, others less so. But the main benefit of raising equity is there's no payback period. So in most cases, especially in private offerings, you're telling your equity investors, we're going to take your money and we're not going to give you any of it back until we feel it's appropriate to do so. And that could be next year, it could be never, but right now we have no immediate plans to pay you anything. So you have a longer time horizon to get your business off the ground and cash flow positive to be able to actually pay to your investors. You're typically pari passu, meaning all the investors are on kind of the same page in terms of the priority of getting repaid. So if there's a liquidation event, all the investors are sitting in the same position versus a creditor like a bank that would be first in line. Another positive is that when you do an equity round, sometimes there's strategic value in who you bring on. So if you can bring on an investor who is an expert in your space or in an adjacent industry or who has expertise, often they're a really good resource. And sometimes just being able to tell people who your investors are, particularly if they're high profile or a good company or a recognizable name, there's some cachet and some value to that as well. The con is obviously the biggest one is dilution. So if you're the owner of your business and you're offering equity, you're selling a piece of your company. Your relative ownership position is being diluted down. So you don't own as much as you did before the equity round. So if the business takes off and does really well, great, because you own a smaller slice of a bigger pie, but you have given away some of the slices. The other con is that investors, and particularly if you're desperate for money, if you are early stage, if you have less of a proven track record, they're going to want certain rights. So they're going to want maybe repayment of their investment over time. There might be some schedule to that. They might want priority, so they might want a preferred return, that they be first in line if there's liquidation or if distribution's made, that they get paid a certain amount before you do. They might want a board seat. This is very typical for investors, particularly if they're making an investment of a substantial percentage, generally over 10%. You're going to see that they're going to want a seat at the table. They're going to say, if we're a big investor in this company, we're going to want some kind of management role. We're going to want some oversight. Maybe we're going to be on the board or be a manager or be a director, depending on your entity structure. The other con, and that people don't think about this as much, is that investors can be needy. Sometimes they complain. If you run your own business and you're the only owner, or maybe it's you and your spouse, you kind of make decisions and you live with them. But if you have investors and you make decisions, they might want to play Monday morning quarterback, or they might want to play Tuesday morning, where's my update? Alternatively, I put this on the slide last night, just thinking that there is kind of a fifth route, which is the franchise route. It's a little bit beyond the scope here, but depending on your business model, it could be another way to scale with other people's money, is to say, why don't you open up a location of my business and we'll license you the name and collect a royalty. But we're going to focus mostly on the equity side and on the needy investors. So if you go down this route, this could be you with responding to people who've invested in your company. One of the things that's really important to think about, and obviously talking to this group, I know that people are in different stages, whether you're a startup or what we call an early stage, or you're established, you're mature, those are really going to affect your options in terms of who you're able to talk to, what kind of funding you're going to be able to get, what kind of terms are going to come with that. So if you're a concept stage company and you just formed your entity, or maybe haven't yet, then you're probably talking to friends and family, people you know, to try to put in money. You might be talking to an angel investor network of people who are willing to invest in very early stage companies. And often that'll involve just, oh, we'll take a piece. It might be a really big piece because most of the cash in your business is represented by our investment. But if you're a little bit farther along and you've kind of done your friends and family round, you've brought in an angel investor, then it might be time to start talking to more institutional investors, like a venture capital fund. If you talk to a VC fund, they're almost always going to have a lot of opinions on how the investment should be structured. So sometimes you have a say in that and sometimes you don't. They often will say, here are our terms, take it or leave it. If anyone's ever watched the show Shark Tank, you probably know that the people pitching on that show are not often directing exactly what the fine print of the legal documents say at the end. If you're even farther along, if you're more of what I call mid-size or large private company, then you're probably talking to more private equity funds, family offices, larger, maybe publicly traded companies in your space, et cetera. But what's really key is that regardless of what stage you're at, is you should be getting your advisors in place before you are talking to investors. So you want to make sure that you're talking to an accountant, you have your accounting piece in place. So someone like REDW, your banker, whether it's Wells Fargo or somebody else, a tax advisor, and then you want to have an attorney on the front end, especially. I can't tell you how many clients come to me and say, here are my documents. We did this investment round earlier this year. We didn't involve an attorney, and I read them and I go, oh my gosh, you gave away the keys to the castle. Why did you do that? So it's important to get those things lined up on the front end, just for your own protection. So the team takeaway is a big deal. You want to make sure that you surround yourself with smart, good people. So one of the other questions I talk to clients about is like, do you know what you want? How much capital do you need? And are you going to need to raise more soon? So having that specific plan about how you're going to use the funds and whether or not this is going to last you through a product development cycle or through the outfitting of your manufacturing plant or whatever, you want to be thinking not just about how much capital do I need right now, but how much capital am I going to need in the future? Because if you're going to be giving away equity up front and you know you're going to do subsequent rounds and raise more money, you're going to be giving up more and more control of the company. One of the other things that matters as well is whether or not you know exactly what you're signing up for in those early rounds. So often investors will have rights of first refusal, rights of first offer, other kinds of rights to step in and be the next round of funding. So an investor might say, we'll give you this much now, and then we want a right of first refusal on any future rounds that we get to step in and participate. So be wary of that, because if you take money from an investor or investment group and then you wish you had worked with a different group, they might have a right to step in and fund the next round. You should also be thinking about what kinds of securities are we offering? What is being presented? What should we present? Depending on how much bargaining power you have, you might be getting to pick the terms of what kind of raise you're doing. So in the startup world, convertible notes are a really common security for investors to choose because they get to sort of have their cake and eat it too. They get to loan the money and be a creditor and have first dibs if the company ever is liquidated. But they can also convert their loan into an equity investment later if it looks like the business is doing well. Other times you're just offering straight up equity. So if you're a limited liability company, maybe you're selling membership interests or units in the LLC. If you're a corporation, you're just selling stock. There are pros and cons to doing it that way. Convertible note versus equity. Obviously, from your perspective, if you're raising money, you probably want to go the equity route and not have to give up that option. But more than likely, you probably are. Depending on the level of sophistication of the investor, sometimes they're going to want more complicated securities like options, warrants, different kinds of derivatives, so that they have higher potential upside. And sometimes there's some tax benefits to doing it that way. That's a little bit more in the weeds, but if you encounter that, then we can talk about it. You also want to try to understand what your company's worth, both pre and post money. So that's where talking to your banker, talking to your financial advisor is really important to know. If we're getting this much money in this fundraising round, what is the valuation that our company is being valued at? And talk to more than one person about that. Do your own homework as well. Valuation, in my opinion, is much more of an art than a science. So you can get widely different opinions based on who you talk to. You should also know or be thinking about in advance, how much are you willing to give up? How much dilution are you willing to take? Because as I mentioned before, owning a smaller slice of a bigger pie is better than owning one whole really small pie. But obviously, if you're going to be doing lots of investment rounds, by the time you get to the end of it, you might own a really, really small slice. So you better hope that it's because you're going to own a really small slice of a very giant pot. The other thing to be thinking about is how much decision-making authority you're willing to give up, especially in tech. And over the last 10 to 15 years, you've seen a much more stark bifurcation of voting and economic rights. So lots of founders will say, well, I'm willing to give up a portion of the profits and losses rights to this company, but I want to be in charge. So I'm not going to give up as much voting control as I am economic interest. So something to be thinking about too is that sometimes you don't always have to give up both, and that can be negotiated. So obviously this is the ideal for a small business or a startup approaching investors, is that you get unlimited funds to work with and you give up no voting rights and minimal equity. The takeaway though is as you prepare for those, you want to think about pitching to investors as you're having house guests over. So if you were having a party and people are coming to your house, you probably put the dishes away, you might fold your laundry, you might sweep. If you're really a clean freak, maybe you wipe down the counters and vacuum. It's the same way with your business. So if you're going to have investors come and look at your business, you want to make sure that your house is in order, you look professional, you have things buttoned up. So do you have an entity formed? Are you an LLC or a corporation? Does that matter? What do your governance documents look like? Do they exist? If you're an LLC, do you have an operating agreement? Was it written by an attorney? If you're a corporation, do you have a shareholders agreement? What do your bylaws say? What rights do you have in advance? In terms of your cap table, is your cap table clear? Do we know exactly who owns how much of your company? It's really common, especially for busy founders, to say, oh, well, I do have this one email I sent to an engineer that we hired early on that said, if we get this next round of funding, that I'll make sure you get 5%. Well, we need to make sure that that's in the cap table, because investors are not going to be happy to see that there's some rights to equity that they didn't know about. Any of your material contracts, particularly if you started your business before you formed your entity, make sure that they're in the company name. Your bank account should be in the company name. All your contracts should be in the company name. All of your intellectual property should be in the company name. And your employees should have signed some kind of document that acknowledges that things that we create for the company are owned by the company and not us. Is your business structure in place? So what do your financials look like? Have they been prepared by real accountants, or is it an Excel that you put together the night before? What does your business plan look like? Is the overview easy to understand? Can we understand the strategy And is an investor going to look at it and say, okay, this all makes sense. I see where you're going. Before you're sharing any of the secret sauce of the company, though, make sure that you are sending an NDA or non-disclosure agreement or confidentiality agreement to potential investors. The worst thing that can happen to you as a startup, particularly if you have something proprietary, is you bring in an investor, you tell them all about your secret sauce, and then they go, no, thanks, we're not going to invest, but these are some really good ideas. We'll take these back to our team. And what does that deck look like? Do you have a pitch deck prepared? Do you have a private placement memorandum if you're doing a private round? Can an investor pick this up and understand what your business is, what your strengths are, what the opportunity is, what the risks are or not? Because there are a lot of risks that you need to tell your investors about before you are offering or selling any securities. There's a lot of foot faults that people suffer because they don't understand the securities laws. Securities laws are extremely complicated, even for attorneys. If you talk to a non-securities attorney, they're probably going to say you need to talk to a securities attorney. And if they don't, then they're an attorney you shouldn't talk to. But many people have no idea that they're selling unregistered securities. So a security is basically any investment contract that's an investment of money with the expectation of profit in a common enterprise through the efforts of others. So if you meet all those criteria, you're probably selling a security and you have to register that security with either the SEC or the ACC or both, depending on what exemption you're looking at. The most common exemption that early stage companies rely on is the happy investor exemption, which is the exemption that says if your investors are happy, they probably won't sue you or report you. That's not a good exemption to rely on because it doesn't always work. I've had plenty of clients who have come to me after the fact, after they've already sold some kind of investment to a potential investor. The business plan doesn't work out exactly how they thought, and now all of a sudden they have a problem. Whereas if they had got it out ahead of it on the front end, given them a private placement memo, ticked all the right boxes, crossed the I's, dotted the T's, they would have been in much better shape. So there's lots of exemptions, but there are criminal and civil penalties if you don't comply. So I always remind clients of the criminal penalties so that they get a little scared and they actually do what they should. I won't get into all the details of the exemptions because I think I'm already almost over time, but Tim went over, so it's fine. And, but the selling to accredited investors is always the safest. Unfortunately, or maybe fortunately, depending on your point of view, the best people to raise capital from is rich people for a couple of reasons. One, because there's more or less protections afforded to rich people if they lose their money, and so safer for you. And also, they're typically less likely to complain than somebody who loses a huge chunk of their net worth investing in your company. It doesn't work out. But you also want to have less than 100 investors. When you get to the 100 investor mark, you run into other regulations involving the Investment Company Act of 1940. Generally, the advice is just stay under that. If you need to get over 100 investors, we can talk. When in doubt, you want to disclose whatever risks there are to investing in your company. And I promise you there are risks. I don't care how strong or established of a company you have, there are risks to your business that you want to be telling your investors about. So if you don't believe me, go on the SEC website, go on Edgar, pull up Apple or Wells Fargo or a really prominent company, and I promise they will have pages and pages of risk factors that describe to their investors all the different ways you can lose your money. So I like to say that when you hire a securities lawyer, you're hiring the opposite of a marketing professional. So the marketing person is going to create your pitch deck, tell the investors why it's such a great company, all the reasons you should invest. This is an opportunity of a lifetime. As a lawyer, my job is to throw cold water on all that and have pages of you're going to lose your money all these different ways. And when you do, you can't say we didn't tell you. So the key takeaways: identify why and what you need capital for, decide whether outside equity fundraising is the right choice for you right now. If it is, get your house in order, get your company as buttoned up as possible so that you look really professional and you know exactly what you're getting into and what the investor knows they're getting into. And assemble a team of professionals. Make sure you have a CFO or an outside CFO, some kind of financial planner within your company or outside your company that's working with you. Make sure you have your accounting firm in place, your tax advisor, your banker, and obviously, most importantly, your lawyer. And then you're off to the races to go pitch. So I appreciate the time, and let me know if you have any questions.
All right, we have one question online, and it may be beyond this discussion, but I'm going to ask if you could just touch on Reg CF or Regulation CF. Do you know what that is?
Send me an email.
Okay.
Yeah,
Okay. And then,
it's not a common exemption.
do you have any advice on how to meet potential investors?
Oh, how to meet potential? Well, I like to think that everyone is a potential investor. If you're a founder, you should think that way, because you never know who might be a potential source of funds. But if you're talking about trying to meet institutional investors, I think a lot of it is leveraging that network of professionals that you've hired. If you talk to your CPA or your banker, they're going to be able to make introductions to people. They have a lot of those relationships. I know I have lots of clients who invest regularly in other companies. We have investors that invest in our companies that we're in touch with, and we're always happy to make those kinds of introductions. So I think the best thing to do is lean on your network. There's also a lot of organizations kind of like this, where you can go and meet people in that space. I know at least like through Grand Canyon University, for example, they have the Canyon Angels Network, where they regularly let companies, typically if they have some GCU connection, come and pitch. And they're people that are in the business of writing checks to startups. So I think finding those different opportunities to get in front of investors, network with those sorts of people is probably the best way to go.
All right, we have and I'm going to mention on that too, the Arizona startup ecosystem, get involved with that. There's lots of different programs, that you can, Venture Madness, the Arizona Innovation Challenge, there's other pitch competitions, other organizations where you can find that startup ecosystem and find investors and others in that range. Jump into the next question we have. It says, be honest, how much of the fundraising process requires a lawyer?
Well, it's a good question. I would say the majority of it does not require a lawyer. The role of the lawyer really is just to make sure you're complying with your obligations and protecting yourself. So I think that on the front end, you want to have a lot of involvement with your lawyer so that you make sure that you're doing everything in a way that's not going to come back to bite you. But in terms of doing the kind of business side of the pitch, you don't need your lawyer there for that. I think that most of it involves not engaging your lawyer. But obviously, funds are limited, right? So the more early stage you are, the more you can kind of take some risk and get some general advice from your lawyer and then go out and see if it works. Because there's no point in paying somebody, $500 an hour or whatever it is, to advise you on doing a $50,000 round for more than, an hour or two. Because obviously that's just going to eat into the fees. If you're doing a $50 or $100 million round, it's going to be a completely company changing event. Then you probably want your lawyer involved almost every step of the way.
So how much would you want? I'm assuming you'd want a lawyer to look at even a $50,000 round, or let's say angel loan from somebody or investment.
Yes.
And the reason I bring that up is I worked for a company in which some investors had about a $200,000 to $300,000 stake, a loan they had done at one point. And this was a $20+ million company at the time. But because of that loan and the management agreement that was tied to that investment, they had more rights in the company than the majority stockholder, which owned more than 50% of the company. And that person no longer has that company.
Yeah, it's a sad story, but it's a very typical one. If you're taking on money, before you take on money from anybody besides, maybe your grandmother, you should probably have your lawyer look at it. As a transactional lawyer, I tell clients all the time, it's way cheaper to pay a couple $1,000s to make sure that, you know, you get legal review of your documents and you get advice on what you're signing up for than it is to hire one of the litigators down the hall to defend a lawsuit or to try to bring a lawsuit when it might be a little bit too late. So, I mean, that unfortunately that happens all the time, because if you don't understand what you're signing, you might be signing up to potentially give your company away. And, you know, at that point, it's a much harder argument to make that, well, this is unjust and you're a court of equity, so do the right thing, versus, well, the document says what it says, and this is exactly what the parties agreed to. So, you know, obviously I err on the side of saying, before you do any kind of loan transaction or equity transaction that you haven't already gotten advice on, that it's worth the hour or two in legal fees to send it to your lawyer and say, hey, does this look good? Is there anything I should know about? Any red flags? Yeah.
It's kind of a two-part question, piggybacking off of what he was just talking about. Are you seeing more activity, you know, before for a company gets to VC stage? Are you seeing more angel investing happening, more safe and convertible notes? And what do you also see as the greatest liability of doing angel investing, whether it's for the founder or the investor?
Well, I think in general, you're seeing more private fundraising as just kind of a blanket statement. So companies are waiting longer to go public. There's more consolidation, you know, in M&A. And so I think companies are doing more private rounds, you know, than historically they had done. In terms of angel investing, you know, it kind of gets back to Robert's point about what are you giving up for those rounds? Because any investor, and, you know, unless they're investing out of the goodness of their heart, and, you know, for the most part, that's not why people make investing decisions. They're going to want as much as they can get. And so that relative bargaining strength is going to come into play where, you know, as Tim mentioned, it's way easier to borrow money when you have a bunch of money in the bank. It's way easier to raise capital when you don't really need it. When you do really need it, investors tend to know that. They can kind of sense that, and through due diligence, they can confirm that. And so, you know, a lot of it just depends on what's your negotiating strength and how compelling is your business case and the use of the funds that you're asking for. Because if you've got a line out the door of different people wanting to write a check because your technology or your business process is incredible, then you can negotiate a lot better terms. And I would say you can go back to the trough a whole lot more often without it being a problem, versus if, you know, you're desperate for cash and there's only one person willing to write a check, sometimes is the money even worth it for what you have to give up, versus pivoting to a different strategy or trying to, you know, grow slower through bootstrapping or something like that. Does that answer your question?
Excellent. With that, we will thank Dom for his presentation. All right, we're going to jump into a break and we will start back right at 10:50. So we'll have a 7-minute break. Please don't forget to sign in on the sheet so we know who's here. hear from Blue Cross Blue Shield of Arizona, and then the Small Business Development Centers, and then we'll have some time for a little bit of Q&A before we wrap up. But so it's all yours.
Thank you. All right, good morning, everybody. My name is Katherine Matson, and I'm the Director of Small Group Sales. So a fun fact about me is I actually celebrated my 24th anniversary with Blue Cross earlier this week. And thank you. I cannot believe how fast the time has gone by. So the purpose of this portion of the agenda is really to give you guys some insights in regards to the small group health insurance industry. So before we jump into it, just by a show of hands, how many of you guys feel as though you're an expert when it comes to health insurance? Like, just raise your hand. I'm an expert. Okay. How many of you feel as though, you know, it's really complicated? I don't really understand health insurance. It's a little confusing. Raise your hand. Yes, you're absolutely right. There's no secret that healthcare in general is complex and can be confusing. But once you get the basics down, it really becomes a little easier to navigate. So there are lots of types of insurance available to small businesses. You have Medicare, Medicaid, individual under 65 plans. You have MET plans, which stands for minimum essential coverage. You have association health plans, trust plans, and the list goes on and on and on. However, today we're going to talk about group health insurance, and this is a medical health plan that small employers can offer to their employees and their families. So the question that you're probably asking yourself as a small business owner is, why should I offer health insurance? Well, the reason is offering health insurance allows you as a small business owner to attract top talent. What employees are looking for is changing. So when I came out of college, my primary concern was, how much money am I going to make? Can I pay my bills? But as a hiring manager, what I'm seeing is that this next generation, their questions are, what are the benefits? You know, I understand you're going to pay me a competitive salary, but what else am I going to get? In addition, providing health insurance, it protects your employees. It protects their mental health, their physical health, and their emotional health. And it really gives them that peace of mind that they're going to be protected in the event that they have a health emergency. And they're going to be able to get the right care at the right time for the right price. In addition, small group health insurance can be less expensive for an employee compared to some of those other options I mentioned earlier. So one thing to note though, you have to determine whether or not your company is even eligible to offer a group health plan. So under the Affordable Care Act, so you're going to hear me say ACA, that stands for Affordable Care Act. The government says that if you own a business and you want to purchase a group health plan, you must have at least one common law employee enrolling on your plan, and that employee cannot be the owner and or the owner's spouse. So if you own a business and it's just you and your spouse, then you'd have to look in the individual under 65 market for your health insurance options. However, if you have a small company, maybe you and a secretary or an administrative assistant, and that person enrolls on your plan, now you're eligible to offer that group health plan. So in the small group market, there are going to be a lot of different options that you'll potentially see or hear from your broker. One are ACA fully insured metal plans. There's partially self-funded plans, and then there are association health plans. So let's just take one of these each at a time. Fully insured ACA plans, these are highly regulated by the federal government. These came about under the Affordable Care Act. They include your 10 essential health benefits, such as maternity care, physical therapy, occupational therapy, speech therapies, coverage for prescription drugs, coverage for hospital stays, coverage for pediatric, dental, and vision. So when you hear ACA metal plans, these are comprehensive, fully insured medical health insurance plans that you would be able to offer to your plan. And when I say fully insured, what that means is as the employer, you're going to pay your premium, and then the insurance company is going to pay the claims based off of your benefit plan designs. Some of the pros for this type of product is they are guaranteed issue. So one of the things that came out of the ACA is that insurance companies are no longer able to decline coverage to an applicant. So we can no longer look at the medical health status of that group. And these are guaranteed issue plans as long as you meet that eligibility criteria. These plans are pool rated. And what that means is no one business stands on its own. All of the groups in that 2 to 50 space come together, and we look at the claims utilization for everybody. And then we develop the rates based off of that experience. These plans are available to groups in that 2 to 50 space, meaning you have less than 51 employees. There's no gender rating and there's no medical rating on these plans. Basically, the only rating factors in an ACA plan is where the group is located, so demographics, and the age of the individual. Some of the disadvantages are, because this is a guaranteed issue product, it may not be the lowest cost option available. There are some constraints to the plan designs because every year CMS requires all insurance companies to run their benefit plan designs through what we call an actuarial value calculator. So we run the benefits through, and we have to make sure that each year those plans still fit within their specific metallic level benefit. So you'll hear platinum level plans, gold, silver, bronze, that's the metal level. And we run those benefits through to make sure the plan still fits on its specific metal level. So the drawback here is that these plans can change year after year. Now, partially self-funded plans, they are gaining some traction in the small group market. These products are built on a self-funded platform, which means that the employer, they're going to be responsible for funding their claims. The insurance company will help administer the plan, but really it's going to be the employer that's funding those claims. But because it's on a partially self-funded platform, it looks and feels like a fully insured product. The employer is going to know exactly what they're going to pay month after month, no matter how their claims are running. Some of the advantages of this plan is that it can be really competitively priced. The reason for that is insurance companies take into account the overall health status of the group. And if your group is younger males, super healthy, you potentially could see a really competitive rate on this type of product. There's greater flexibility in the plan designs. They're not as regulated compared to the ACA plans. And we do gender rate in this type of product. So young males are going to have a better rate than young females. And then older females will have a better rate than older males. Some of the disadvantages are that if you're a small employer, you may be required to fill out an individual medical questionnaire. So this does require some effort on the employer's behalf, where you have to send out an individual medical questionnaires to all of your employees. They fill out the information. That information is then securely collected and submitted over to the health insurance company for evaluation. And on these products, employers can be declined. So you need to medically qualify in order to participate on this type of a product. Association health plans, these are products that are specifically designed for specific industries, such as doctors or tech or construction workers or auto workers. They will allow groups of 2 to enroll, but some of the disadvantages are these groups require that the employer be a member of the particular association. So Arizona Tech Council has an association health plan. Arizona Medical Association has an association health plan, but you have to be a member of that association before you would even be able to enroll on a plan like this. The fees may be a little higher in an association health plan because of the third-party administrators that help facilitate this type of product. So as a small employer, you're going to need to know a few things. So no matter what product you choose, these are some common terms just across the board. One is premium. Now, premium is the amount of money that the employer, in conjunction with their employees, pay the health insurance company in order to have the health plan. Then we have copays. Now, copay is a small fee in your benefit plan design that you have to pay to utilize services. For example, if you're going to see your primary care physician, you may have to pay a $25 copay in order to have that visit. Deductibles, this is the amount that has to be paid for major services like your inpatient hospital stay or an outpatient surgery. Your deductible is the money that you need to pay before the insurance company will pay the claim. Co-insurance, this usually kicks in after your deductible is met, and it's the percent of the claim that the insured will pay versus what the insurance company pays. And then your maximum out-of-pocket expenses. Now, this is your stopgap. This is the maximum amount of money that you pay out within your plan year for your medical expenses. So now that you have these terms down, when somebody asks you, well, what type of plan do you have? You could say, well, I have a $2,000 deductible with a 20% co-insurance. My maximum out-of-pocket is $5,000. And my copay to see a provider is $20, or my copay to see a specialist is $50. So typically that's what you're going to hear. That's the jargon, that's the lingo when it comes to your health plan. So when you're trying to figure out what type of plan to offer to your employees, you have to make some decisions. You have to narrow down your choices. So the first question that you might ask yourself is, do I want a PPO or I want an HMO? PPO stands for Preferred Provider Organization. These types of products offer in and out of network coverage. You can see a specialist without a referral. You're going to have a wide range of providers to choose from. And PPOs allow for individuals to receive coverage when they travel outside of the state. Or if you have an employee that lives in California and you have one that lives in Massachusetts, a PPO is probably going to be a better option for you, because on this type of network, your employees can use the PPO network. HMOs, they're a little more restrictive when it comes to provider choice. These products, the big difference between a PPO and an HMO is that you must stay in network when you have an HMO. If you go out of network, there's no coverage for that service unless it's an emergency. And usually on an HMO, you're going to be assigned to a PCP that's responsible for coordinating your care. And some people love that because, again, the healthcare system is complicated. And if you have a medical issue, it's not always clear as to who you should see to address the issue that you have. But if you have that PCP in your corner and you can go and say, this is how I'm feeling, I don't know really where to go from here. On an HMO, that PCP is going to be required to designate the specialist that you should and can see. In addition, you're going to ask yourself, do I want a traditional copay plan or do I want a high deductible health plan? Traditional copays, these are really popular. These are the plans that most people know. You're going to have a copay for most services to see your PCP, your specialist, urgent care. You may have a copay when you go into the emergency room. Consumer-driven high deductible plans, most people aren't super familiar with these types of products, but if you're business savvy, this is definitely a product you want to take note of. These are high deductible health plans that can be paired with an HSA. High deductible means you're going to be responsible for your first $1,000 or $2,000 worth of care. So the big difference here is if you're on a copay plan, you go to see your PCP, you may pay that $25 copay. If you're in a high deductible health plan and you go to see your PCP, you may pay $150 for that service. But one of the things that a high deductible health plan can do that your traditional copays cannot is that you can pair these plans with a health savings account. And some of the advantages of a health savings account is that all the money that you contribute it's tax deductible. The interest that grows in those accounts, when you take it out, it's tax-free money. And as an employer, you can contribute towards your employees' HSA. So you can help them build up their accounts so that when they go in for services, they have the money to cover their deductible. You can go to irs.gov and it'll give you a full list of all of the qualified medical expenses that you can use your HSA dollars towards. So outside of the medical health insurance, you can use your HSA savings account to pay for dental care, contact lenses, hearing aids, and the list goes on. And the last thing, and one thing I really like about HSAs is that if you decide to leave your employer, you get to take your health savings account with you. It's not a use it or lose it type of thing. I mean, the money gets deposited and it's the employee's money, and they can use that to pay for their medical expenses, or they can use it down the road as they get older into those retirement ages. So it's just another great way on how people can save money for their medical care and be a little more conscientious as to how much things cost when it comes to utilizing medical services. The next thing that you might want to take a look at is the network that's being offered by the insurance company that you're evaluating. So you're going to see options for a broad network where you have lots of providers, lots of specialists to choose from. But these types of products are usually a little more expensive, but it gives you greater choice. Or you may want to put a lower cost option in place for your employees and look at a narrow network option. These have fewer providers, but the trade-off is because you don't have as many providers, these plans are typically priced anywhere between 10 to 15% lower than what you would see on a broad network type of product. At the end of the day, the takeaway here is make sure that you look at the carrier's website and ensure that your provider is within their network. Because when you go out of network, then your costs escalate and it becomes really expensive. When you stay in network, then the plan works as designed, where the insurance company is going to pay their share and the members are going to pay their share. So the question we get most often from small businesses is, all right, well, how do I get a quote? How do I know how much this costs me? And the answer that we have to give back isn't always great, because we can't exactly tell you how much it costs until the employer fills out a member level census. This census will capture every single person within your business that you need to provide health insurance for. That census information is sent off to the insurance companies, and then we can generate a proposal for you to tell you how much it will cost to cover your employees. And that census is unique to each business. So you get your proposal, you say, hey, I like what I see. All right, I'm ready to do this. I can see that this is something that we can afford to provide for our employees. So what's next? Well, the first thing is you want to select your plans and your network that you want to provide to your employees. Then you're going to have to determine your contribution approach. We've seen some employers pay 100% of the employees' health insurance. We've seen some pay 90% and some pay 50% of that employee-only rate. And then you have to schedule your open enrollment meetings. This is where you bring all your employees into a room and you leverage your carrier partner and your broker. And we meet with the employees to help them understand the benefits that they have available to them. And then the last step is super easy. You fill out the paperwork and you're on your way. The paperwork is fairly straightforward. Most insurance companies will ask you as the business owner to complete an employer application. You have to do a group size questionnaire. This is 5 questions just to make sure that we're rating your account appropriately. If you have less than 10 employees, usually carriers will ask for a wage and tax document. And we ask for the applications to be submitted as well. So I talked mostly about medical health insurance, but as a business owner, if you want to develop a comprehensive benefits package, you're going to want to look at some other options as well, like dental insurance, life and disability, employee assistance programs, critical illness, and vision. Has anyone looked in the newspaper or online recently? And if you're looking for a job, what do you typically see? We offer medical insurance, dental insurance, vision insurance. So they give the full package. And all of these plans are available to small businesses as well, as long as you have 2 or more eligible employees. Some common requirements, you need to have at least 70% of your eligible employees enrolling in your group health plan in order for that plan to be effectuated. Employers are also required to do a minimum of a 50% contribution towards the employee-only premium. The exception here is under the Affordable Care Act, we have a small group open enrollment window. It runs from November 15th to December 15th for a first of the month effective date. During that window, employers do not have to meet the participation or the contribution requirements that carriers have in place. In addition, as a small business, you want to make sure that you're not discriminating against your employees. So discrimination is not permitted. You have to treat all of your employees equally and fairly. So it's important to make sure that you clearly outline who is eligible for your group health plan. And here in the state of Arizona, many COBRA as well as COBRA laws do apply. And what this is the ability for a terminated employee to continue their health coverage after they leave the employer. Now, as the employer, you can require that terminated employee to pay for their full premiums. And there are companies that can help facilitate this process. So with that, I'm going to pause for any questions. Any questions?
All right, we got one question. Is there a number of employees below which it would be cost prohibitive to a small business to offer group health insurance?
No, there's no special number out there that says, hey, if I have less than 3 employees, I don't think this makes sense from a business perspective to offer health insurance. We actually have groups of 1, and how you get to a group of 1 is if you have the owner and they have an administrative assistant, the owner may waive coverage and enroll on Medicare, but they still want to provide health insurance for their 1 employee. So we can technically write a group of 1 as long as that individual is the common law employee and not the owner and or their owner spouse. So definitely there's no magic number out there. And I know I might be a little biased here, but in my opinion, you can offer health insurance to your employees, you definitely should. I mean, employees that feel protected and valued are going to be loyal employees to you in your business. And they're going to help you grow your business. Many of you in this room are just starting out. You want employees to be in lockstep with you as you grow your business and identify your own personal goals and objectives. So hopefully that answered your question.
I have a question. So if you leave with the HSA, can you continue to contribute into it?
If you, as the employee, leave the business that's providing the high deductible health plan, you would no longer be able to contribute into your HSA until you establish another high deductible health plan. So while you wouldn't be able to contribute to the plan, you can still utilize the dollars in the account to pay for a qualified medical expense.
Okay, so I resigned from a position and I have a HSA,
Mhm.
but now I'm in my own practice.
Then you have to, so the question is, I was with the business, I had a high deductible health plan and an HSA. I decide, hey, I'm gonna go out on my own, I'm gonna start my own practice. What happens to the HSA? If you start your own practice, in order to continue to contribute to that HSA, you need to work with a health insurance company to reestablish the high deductible health plan. So once you get that high deductible health plan back in place, then you can start contributing to your HSA once again. If you decide that I want a copay plan, then in that case, you would not be able to contribute to the HSA, but you could still use the money that's there to pay for a qualified medical expense like contact lenses or a hearing aid or, prescriptions, those types of things. Make sense?
We got a couple online questions that are really good. One, it'll be quick. It says, can both HMO and PPO have high deductible health plans?
Yes, both HMO and PPO, there are high deductible health plan options on both of those types of products. So again, just wanted to reiterate, the biggest difference between a PPO and an HMO is that on that PPO, you have in and out of network coverage. You're gonna have a wider range of providers to choose from, and you can travel with that plan. Or if you have employees that live outside of the state of Arizona, they're gonna be able to access a national PPO network. Usually on an HMO, those are state-specific plans or they're county-specific, and they only offer in-network coverage. So you must stay in-network on an HMO.
All right, and one last one. I think this will wrap us up right as we get towards time, but it's a good one to end on as well. It says, when would a business go with one of these small group plans rather than engaging a PEO? And for those that don't know, a PEO is a professional employers organization, to use the group scheme they offer?
That's a really good question. And it's going to be up to each of their employers to make that evaluation. So usually with a PEO, you're going to be locked into just a certain set of plan designs that the PEO offers. If you decide to set up the group health plan on your own, there's a wider range of products that you can choose from, a wider range of prices to choose from. And, but at the end of the day, that employer has to make the determination which route they want to take.
And I'm going to share an example. In a previous business I was with, I looked at both. We were with a PEO, but I was also looking outside at options. And there's things to look at in that way, but if you're with a PEO, you're also generally with them for other factors as well, not just the healthcare piece.
Right, that is true. That's true. There's a lot of organizations like PEOs that help small businesses with HR compliance, with payroll, etc. So typically when a small business is going down the PEO route, to your point, yes, they're looking at those other services that are being offered. And I'm sure there's a fee associated with that as well.
Yep. Awesome. Thank you. We're right on time. Perfect. With a lot of good questions. All right, we're going to go ahead and turn the time over to Nancy with the Small Business Development Center. She's working at the state office, but is also the previous director for the Maricopa Center. So we're excited to have her with us.
Thank you very much. And I will not keep you too long so that you don't miss lunch. This is like one of the worst times to speak. Thanks, Bob. That or right after lunch. You guys are sleepy, but that's obviously not the case today. Whoops. Thank you. So as Bob said, I'm Nancy Sanders. I've been with the Arizona Small Business Development Center Network for a long time. And as a former business owner and entrepreneur, it's been really rewarding to first work with small business owners to help them start and grow their businesses. And then now, then I transitioned to running the biggest center in the state, Maricopa Center. And now I'm on kind of a temporary reassignment to the state office. And my role is to actually develop plans and programs that provide more resources to small business owners. So one of those collaborative relationships is with Arizona Commerce Authority. So, but that's not why I'm here today, is it, Bob? So some of you may be familiar with the Small Business Development Center, and we are the largest, Arizona's largest, most accessible resource for support for small business owners at every stage of development. So a lot of times people come to us and they say, hey, want to start a business, not sure what to do, not sure how I should be offering my services, what should I charge, what should my marketing be like. We're here to help, and we've got resources and guidelines. We have a team of professional business advisors. And I should have said in the beginning is that we are funded by the SBA, the Small Business Administration, and we also receive funding from our statewide host, which is Maricopa Community Colleges. And then we have partnerships and collaborations. And we also partner or collaborate with outside for-profit entities. And you're going to hear a little bit about a grant that our network is the beneficiary from that came from Wells Fargo. So you're going to hear about that a little bit later too. We've got 10 service centers in Arizona. We are county-based. Some centers cover multiple counties. We are available to do virtual and in-person meetings. So there's someone, no matter where you are in the state of Arizona, there's a counselor that's available to you. A few little stats here. I don't know if you can see those, but obviously the last couple of years have been very hard on Arizona's small business owners, right? And so last year we counseled almost 6,000 businesses in Arizona, but helped them grow their revenues in some cases, and also access that very important capital to help them stay in business and in some cases grow. And some of that capital came in the form of traditional financing, as Tim talked to you about, debt financing, and then some of that, of course, was private equity, as Dominic talked to you about as well. So we're here to talk about what are the resources we have to help small business owners grow their business. And so I'm going to talk to you primarily about two programs. Actually, it's one program and then an extra program, sub-program. So we have devoted some resources to develop what we call a small business growth program. And so that is an online portal, if you will, that develops or that directs people to get services where they need them. So that might be in terms of launching a business. It might be in terms of growing their business through either buying another business or reinvesting back in that business. And then you're going to hear about this Arrow pilot that we're doing, which is thanks to a grant we received from Wells Fargo. If you're interested in these services, you can go to azspdc.net, which is our network site. But I think it's easier to remember maricopa.edu/growth. So you'll see information about the small business growth services, and then you'll also hear about Arrow, other things that we can help you grow your business, other services we have to help you grow your business. We provide advising on business strategy, business planning, financial planning. We are not accountants, nor do we play them on camera. We don't provide either tax or legal advice, but we connect to people like Dominic, like Cheryl, to provide those resources to our clients. And then of course, sales and marketing, everybody wants to grow their top line, and everyone needs resources right on how to do that. So let me show you what this portal looks like. This is what we call the small business growth portal. Again, if you go to this website, which on my next slide, there's going to be a QR code. It's asking you, hey, are you looking to start your business? Are you looking to grow your business? Or do you want to turn your potential challenges, your operational challenges, into an opportunity to work with another small business, perhaps someone who's just getting started, a fledgling business? We're also have a targeted outreach to work with our students because we're hosted by Maricopa Community Colleges. A lot of our students are starting businesses. So if you clicked on either start or grow or match, it would pop up, another window would pop up, and you'd be asked to fill out just very brief information, your name, your email address, and then what county you're in, because we're going to match you to the services that are available in that county. So let me talk to you about Arrow. So Arrow is advancing entrepreneurs ready for, advancing entrepreneurs ready for opportunities. And so this is this collaborative partnership. You'll see some of our supporters down at the bottom. Wells Fargo provided funding to launch this portal as well as provide stipends for small businesses. So the idea behind this is to create a marketplace, if you will, for small businesses who need assistance to maybe get up and running, or maybe you're an established business and you have a research project or you want a social media campaign. The idea is that we're creating a marketplace. This doesn't exist in Arizona. It probably doesn't exist in most places. And so this is a pilot. What we hope and what has generated a lot of interest so far is that there are either companies who are or foundations who are interested in continuing this work, or perhaps it's through fees, small fees that are provided by the people who are providing the services and people who are looking for services. So it says I'm a service provider, I'm a service seeker. So let's just say that you're starting a new business and you need some marketing assistance. So you would go to this website, fill out a questionnaire about your business and what your needs are. And then that project is posted on this portal, this matchmaking portal. And so let's say someone else, you need assistance with marketing and social media. Someone else has just started a business. Maybe they've been in business just a few months. Maybe they're a student entrepreneur starting a business while they're pursuing their education. They go on and they see your project posted. And the projects are 20, 40, or 80 hours. The stipends go up to $1,200. So it's not, it's not a significant amount of money. If you were going to a business that was already established, they would charge you hundreds of dollars more, thousands of dollars, maybe tens of thousands of dollars more, depending upon what the project was. But the idea is to match small business owners with these projects and to help businesses with challenges they have that perhaps they're not sure where to go. Either they don't have the resources to explore how to get their challenge met, or they just are starting out and so they don't have the resources available. So this QR code takes you to this site, which is Arizona Arrow, AERO.com. Again, that pops up and you'll be asked to fill out some information about your business and the projects you're looking for. Some of the other areas that we help small businesses, and we talked a little bit about this earlier. There was a question around, hey, I'm just starting out. How do I compare my business or my industry to others? So there's a couple of tools there that we use. Some provides data on a statewide basis, and some also looks at nationwide. What are the companies that are your size around the country? What's kind of a target or an average gross profit, for example? How much are those businesses spending on marketing? Things like that. We also have a couple of tools that help businesses plan. So you don't just need a business plan if you're going to go see Tim about a loan. You don't just need a business plan to get funding. You need a business plan that is updated at least, I'm going to say, twice a year. as a business, as a former business owner. You need to, what are your goals? What are your plans? And then are you tracking to achieve those goals and objectives? We also, a lot of the work we do obviously is geared towards helping small businesses identify lenders, who's the best fit for them, depending upon what their needs are, what their industry is, how much money they need. So we provide guidance to our clients in terms of putting together not just your business plan, but also putting together, what does that lender application look like? What are they going to be looking for? How do you assemble those documents? We've also got financial benchmarking data financial benchmarking data, not just research, but also benchmarking data as well. And we also have another tool called Growth Wheel, which provides, I'm going to say, it's not really courses, but material, worksheets, articles, things like that for common business challenges and ways to address them. So all of these services and tools, products, et cetera, counseling is all available to our clients. Our clients don't pay a fee. And in general, we don't charge for any of our services. We used to have some small fees associated with training, but now since most of our training is done or offered online, we really don't charge any fees. We can't charge for our counseling services. If you're interested in more information, or as a business owner, you're ready to get started, or you're thinking about starting a business, you can go to our network site, which is at azsbdc.net, and fill out a request for counseling. You'll be matched, if you will, with a counselor that's in your geographic area. And also, depending upon that, your needs, perhaps industry expertise as well. So I think that's the bulk of what I wanted to share with you. I could go into a lot more detail, but I'm sure there are some questions, or I hope there are some questions, or maybe just everyone's hungry and wants to go to lunch.
Nancy, you got a question, and it's from Tracy. It says, curious if the SBDC offers assistance in finding skilled labor workers.
Well, so we are not an employment organization. However, we do work with our clients in terms of some of the things that Katherine talked about, in terms of what are things that are appealing to people who are seeking jobs. What's a certain strategy? Katherine talked about health insurance. So we provide guidance to our clients around how to recruit clients. We also have resources, or are familiar with other entities, so we could introduce them to an organization or a company that provided skilled labor in that, whatever that area was. We also, because we're part of Maricopa Community Colleges, they are, I think, the largest workforce development organization in Arizona. So they also have resources to identify, help employers find skilled labor.
Yeah, from my experience, most of the SBDC offices around the state have the connections with Arizona at work in their community. And that's one of the best places for helping with that. Any other questions from the group? Any questions in general about today's session? I'm going to leave this thank you up there so you have the contact information for Nancy. The SBDCs are a great partner. Again, they're a no-cost resource that is available throughout the state. And they can help guide through all the stuff we've heard previously leading up. One of the reasons we had Nancy come and share about the SBDCs is because they can do all the stuff and help lead to the accountants and lead to the lenders or the venture capital or the different parts of the things you're going to need in your business as you're looking to grow. And a lot of people think that they're for startups. No, they're for small businesses. And the SBA's definition of small business can be a very large business and still be considered a small business. So they can work with you up until you're at least, 35 million in sales and 500 people approximately, give or take, depending on the industry. So again, they're a great resource. You can reach out to Nancy directly. You can get a hold of me and I can get you in contact with any of the directors as well. So if we don't have any more questions, Faith, do we have any more questions pop up? All right. Well, we want to thank everybody for being here. I want to make sure those that are in person attendance that you get noted on the sign-in sheet right here on the table up front. We want to thank all of you that are online for participating. We're going to send out some feedback about this too. This is the first, I think, hybrid type event we've done here at the ACA. And I think it went pretty well. So we're gonna get some feedback. We've partnered with the Phoenix Business Journal on 4 workshops. This is the second. So we're going to do another one in August and another one in November. And so we're going to seek out some feedback so we can make sure we are getting the topics and the information that's going to help businesses grow in Arizona. That's our goal, is to bring things to help you as you're on your journey to grow and strengthen your business. So again, thank you for being here. We appreciate it. We want to thank all of our presenters for their effort, their time, their expertise. Thank you for being part of this. And with that, we'll go ahead and wrap up. Thank you.
Yes, lunchtime.
That was a pretty quick 2.5 hours.